Hi, everyone. This is Emily Platt from the investment team, and welcome back to Markets in 2 Minutes for October. As we enter the fourth quarter of 2022, we look back on what's been one of the worst 9-month stretches on records for stock and bonds. The S&P 500 dropped more than 25% this year, making it only the ninth time to happen since 1950. If you look to the table here, noting historical bull and bear market periods, you'll note that we just came off a period where we gained more than 400% post 2008. It's also interesting to note the length of time bull and bear markets last, with the average bear market lasting only 20 months compared to that of a bull market at 51 months. One thing that history has shown us is that eventually, after every bear market, we have seen all-time highs in US stocks. If your horizon is long and you're net adding to your portfolio, weakness now should mean better returns later. This chart shows the drawdowns, the S&P 500 in orange, and the subsequent 5-year returns shown as the dark blue bars, with the shaded area noting when the market was down more than 10%. Basically, what you see outside the tech bubble is that when you're amid the drawdown, you have a higher expected return over the next 3, 5, and 10 years. When you're in the worst of it is when your expectations for future performance should be the highest. This holds true when we recently ran our internally generated and third-party long-term capital market assumptions, showing expectations for future performance being significantly higher across almost every asset class. With that, there's still a lot we cannot answer. Things could likely get worse before they get better, and we wouldn't be surprised if we continue to see stocks fall and volatility continue through the last quarter of the year. In times like today, it's important to remember why we don't try and time the market. As much as we would like to avoid market drawdowns, to do so means exiting at the right time, but more importantly, knowing exactly when to get back in. Without exact insight into the future, those are difficult calls to make over and over without potentially adverse impact on your portfolio. History suggests that periods of drawdowns like we've seen this year have often been followed by more favorable returns over the subsequent 3 and 5-year horizons. Pulling back on equity market exposure when markets are volatile can lock in losses and most likely lead to missing out on subsequent rally. Ultimately, as long-term investors, we seek to find opportunities in this down market and focus on meeting clients' long-term goals.